Did you know Walmart just announced a quarterly revenue of $165.6 billion? A staggering figure that leaves everyone amazed. But at the same time, prices at this retail giant are skyrocketing daily, making countless American families struggle to stretch every dollar. Imagine this. Tariffs on imported goods, especially from China, once reached a shocking 145%, more than doubling the product's value. Although now lowered to around 30%, the volatility and historically high tariff rates remain a significant burden for importers like Walmart. Walmart isn't a manufacturer, they gather goods worldwide. When facing such extra costs, the easiest way to balance the books is to raise prices for consumers. Groceries, household items, school supplies, none are spared. American families, especially low and middle-income groups, feel this price hike in every shopping trip and receipt. This decline in purchasing power causes people to skip non-essential products, spreading negative effects across the retail market and related services. No one enjoys paying more for essentials. Interestingly, despite Walmart's quarterly revenue topping $165 billion, their profits are shrinking significantly. Rising shipping costs and soaring import tariffs erode their already thin profit margins. Walmart cannot simply absorb all these costs without affecting operations. Holding prices low without adjustment could force cuts in investment, workforce, or service quality, all ultimately harming consumers. Therefore, Walmart publicly raises prices as both a business strategy and a transparent signal about the challenges they face. This sheds light on the broader struggles of major companies amid global economic uncertainties and constantly shifting trade policies. Beyond raising prices, Walmart is implementing profound changes in supply chains and operations. To reduce tariff costs, they are shifting sourcing to countries with lower tariffs like Vietnam, India, and Mexico, where production and import expenses are more manageable than China's current rates. Simultaneously, Walmart is pushing automation at warehouses and stores to boost efficiency and cut labor costs. However, this means fewer traditional jobs in American communities, especially where Walmart is a key employer. While saving costs, automation raises unemployment concerns, causing many families to lose stable incomes. In short, Walmart faces a tough choice between survival and profitability in a difficult market, but the price may be paid by American workers. This shift also demands new skills from workers, pushing the labor force toward technology-focused roles. Workers without access to training may find themselves left behind in this fast-changing environment. Local economies dependent on retail jobs may face increased instability and social challenges. At the same time, automation helps Walmart maintain competitive pricing in a volatile global market. Balancing cost-saving innovations with community welfare remains a critical challenge for the retail giant. The effects of price hikes and labor changes go beyond individuals to deeply affect communities, particularly in rural and suburban areas. Here, Walmart is not only a shopping hub, but a primary source of employment. Cutbacks in staffing reduce household incomes, weaken purchasing power, and trigger negative cycles like lower local tax revenue, which harms public services and social welfare. Moreover, as consumers spend more on necessities, they cut back on other expenses, decreasing revenue for many sectors and services in the economy. This creates a difficult cycle. Rising prices, reduced spending, falling revenue in other industries, slower economic growth, fewer job opportunities. Amid America's ongoing recovery from the pandemic and inflation pressures, such Walmart changes could slow progress and add challenges for both citizens and policymakers.
$33 trillion. This is not just a number, it's a burden looming over the world's largest economy, a national debt now larger than the combined GDP of Europe, Africa, and South America. And that number continues to grow. The consequences of an exploding national debt. This $33 trillion debt is far more than ink on a balance sheet. It consumes a substantial portion of American taxpayers' money. Every day, nearly $3 billion is spent, not to build bridges, hospitals, or schools, but simply to pay interest. In fact, Interest payments have now surpassed U.S. defense spending, despite the country maintaining the largest military budget in the world. If interest rates rise further, this burden will only intensify, reaching levels comparable to the entire U.S. Department of Defense budget. At that point, programs supporting healthcare, education, and social services may face deep cuts, as spending obligations mount and revenues struggle to keep up. America's financial system inches closer to a breaking point. Root causes, massive spending, and eroding confidence. To understand how we arrived here, we must look back. In 2008, the global financial crisis struck. To stabilize the economy, the U.S. launched the TARP program, allocating $700 billion to rescue major banks. Then, in 2009, an additional $831 billion was spent to stimulate recovery. A decade later, the COVID-19 pandemic forced the government's hand again. More than $5 trillion was deployed in emergency relief, business support, and direct payments to citizens. Throughout the 2010s, near-zero interest rates made borrowing appear virtually cost-free. Trillions were borrowed without immediate fiscal pressure, but inflation returned. Beginning in 2022, the Federal Reserve embarked on its fastest rate hike cycle in 40 years. And suddenly, the national debt became a ticking time bomb. Far-reaching impact on American life and global stability. Start with everyday Americans. As foreign investors sell off U.S. bonds, the dollar weakens, diminishing purchasing power. In an economy where imports make up nearly $4 trillion annually, price increases ripple across fuel, food, electronics, virtually everything. Gas prices soar, transportation costs climb, daily living expenses surge. Electricity, gas, and water bills balloon. To control inflation, the Federal Reserve keeps interest rates elevated, but this, in turn, slows growth, raising the risk of a prolonged recession. Globally, the shockwaves are just as significant. The US dollar, long seen as the world's reserve currency, now faces scrutiny. As trust erodes, central banks are exploring alternatives. China promotes the yuan in global settlements. Russia, India, Brazil, and South Africa are expanding local currency use and gold-backed trades. Even the euro and Bitcoin are emerging in cross-border deals. Should the US dollar lose its status, America risks forfeiting its financial soft power, a tool it has relied on to shape the global economic order for nearly a century. The difficult choices ahead: cut spending or print more money. In confronting this crisis, the U.S. faces two main paths. First, drastically cut public spending. But politically, this is nearly impossible. Defense, Social Security, Medicare, these are deeply entrenched commitments. Without reducing these large expenses, any cost-cutting becomes largely symbolic. Second, increase the money supply. In theory, the Federal Reserve can print as much money as needed, but doing so would further erode trust in the dollar, a double-edged sword. Yet beyond these two options, there is a third, one that requires vision and long-term resolve. Invest in domestic strength, expand renewable energy development, boost extraction of critical minerals like tungsten and rare earths within U.S. borders. Strengthen domestic supply chains to reduce dependency on imports. This is not a short race. It's a long-term national project, demanding policy stability across multiple administrations, but perhaps the most sustainable path forward.
Trade officials from both countries were in Switzerland for a series of discussions this weekend.
Has it been a huge day in the world of money, power, politics?
Okay, more now on the trade tensions, and the companies in the US are rushing to get shipments.
The United States and China have sought to end their trade war for now by agreeing to dramatically slash the tariffs.
双方已经刚刚发布了会谈达成的联合声明。
We have reached an agreement on a 90-day pause.
The U.S. once imposed tariffs up to 245% on Chinese goods, and China retaliated with 125% tariffs on American products. Now, both sides have agreed to cut tariffs by 115%, down to about 10% over the next 90 days. What is happening? The tariff reduction agreement between the U.S. and China, after years of escalating tariffs that froze trade between the U.S. and China, This mutual tariff cut signals that both sides want to avoid further damage. The previously high tariffs had driven up prices sharply, disrupted global supply chains, and directly affected businesses and consumers. Now, the tariff cuts help reopen trade channels, reduce transportation and production costs, thereby speeding up the flow of goods and supporting the recovery of the economy and the global supply chain, which has been under great pressure. This could be the starting point for the world's two largest economies to move toward a more stable phase of cooperation instead of prolonged confrontation. Background, reasons, and objectives of both sides. Before the agreement, the tariff war between the U.S. and China had wide-reaching impacts. The U.S. imposed high tariffs to limit cheap Chinese goods, aiming to protect domestic manufacturing and reduce a trade deficit worth hundreds of billions of dollars. In response, China retaliated with tariffs that sharply increased the cost of imports from the U.S., putting pressure on consumers and businesses in both countries. For China, a real estate crisis and rising unemployment have added stress to its economy. Meanwhile, American citizens have suffered from rising living costs as imported goods became more expensive due to tariffs. Additionally, China worries about being isolated from global supply chains as the U.S. signs new trade deals with other partners. Although the tariff reduction is a positive sign, economic and policy conflicts remain, making future cooperation challenging. In this complex context, can both sides find common ground to build a stable and sustainable trade relationship? Impact on people in both countries. High tariffs have pushed the prices of many imported goods to uncomfortable levels, ranging from electronics and clothing to essential food items. Consumers in both the U.S. and China have had to spend more on familiar products, increasing financial pressure on household budgets and negatively affecting quality of life. The tariff cuts will help ease prices, making goods more accessible and reducing financial strain on people. Furthermore, lowering tariffs will help businesses reduce production and raw material import costs, maintain employment, and stabilize the labor market. However, the actual benefits reaching consumers may not happen immediately and will depend on factors such as company pricing policies and the global market situation. Future outlook and challenges. The tariff reduction agreement is only effective for 90 days, serving as a trial period for both sides to assess cooperation levels. This is a positive sign, showing that both the U.S. and China want to temporarily set aside disputes to stabilize trade. However, many core issues such as trade balance, intellectual property rights, and industrial policy remain unresolved. Whether the global supply chain can sustainably recover depends on the ability of both sides to continue negotiations and build long-term trust. Otherwise, tensions could flare up again, bringing many negative consequences for the global economy.
Well, it is going to be crushing. He sparked a trade war. I talked to farmers who are still digging out from the tragedy that was, and now they're looking at it again.
Right. Are you angry?
It's difficult to be angry on somebody else's behalf.
So it's not about you. It's not about your farm and the fact that you bought a farm to avoid inheritance tax.
But as we think about the farmers and the headwinds that they face, I can think of a number of them. Fertilizer costs, fuel costs, labor shortages.
$27 billion is the value of U.S. agricultural exports to China in 2024. But in just 1 week, soybean exports dropped 50% and pork fell 72%. Why is this largest market pulling back? What consequences will American farmers face? The hardship of American farmers and China's strategic shift. In 2024, China imported $27 billion worth of U.S. agricultural products, making up the majority of the country's total agricultural exports. However, as tariffs increased sharply, everything changed rapidly. Within a single week, soybean exports to China fell by 50% and pork by 72%. This is not just a number. It represents a real crisis for American farmers. Inventories piled up unsold, prices plummeted, forcing many to suffer heavy losses and even face bankruptcy risks. Why did China withdraw? They quickly shifted to other partners. Brazil became the new largest soybean supplier, with forecasts of over 31 million tons imported just in the second quarter of 2025. China also invested heavily in Brazil's port infrastructure and signed long-term contracts with Argentina and several other South American countries. This is not a temporary reaction, but a long-term strategy to reduce dependence on U.S. agricultural products. Impact in the U.S. and political reactions. The direct consequence of losing the Chinese market is massive economic damage on U.S. soil. In states like Iowa, farmers reported losses of more than $25 per acre. Total damages run into millions of dollars regionally, severely affecting the livelihoods of thousands of families. Not only farmers, but related industries, such as agricultural equipment, feed stores, and machinery repair services, are also seriously impacted. Many small businesses are forced to scale down and workers are laid off. Politically, pressure from this crisis is causing lawmakers to consider proposals to limit the president's unilateral tariff powers. The goal is to avoid uncontrolled market fluctuations that severely harm agriculture. Widespread discontent among farming communities is strongly shifting voting trends in traditional agricultural states, opening new political developments, new development strategies, and the future of American agriculture. Facing major disruptions from the Chinese market, American farmers and policymakers are beginning to explore new directions to reduce this dangerous dependency. One key strategy is diversifying export markets. Southeast Asia, Africa, and Latin America are seen as rapidly expanding potential markets with growing demand for agricultural products. Developing these markets not only reduces risks, but also opens opportunities for sustainable growth of U.S. agriculture in the long term. Moreover, the agriculture sector is focusing on investing in value-added products and food processing. Instead of only exporting raw materials, developing processed products with higher economic value will increase profits and competitiveness globally. Technology also plays a critical role. Applying modern supply chain management technologies like blockchain helps ensure product origin and quality, while enhancing operational efficiency and transparency in international trade. The future of American agriculture requires a stable multilateral trade strategy that avoids volatile tariff policies. Innovation in technology and market diversification are the keys to maintaining competitiveness and sustainable development amid today's complex geopolitical environment.
This warning from the CEO of the nation's largest automaker, General Motors, about the impact of the tariffs on the car industry.
He's announced a 25% tariff on all cars imported into the United States.
And it's likely to increase the prices for consumers.
Laying off 1,000 employees as it looks to cut additional costs.
GM has suspended production at its U.S. plants, cutting thousands of jobs, including 1,200 in Canada and nearly 200 in Michigan. This is not due to a recession or supply shortages, but a strategic decision to shift to electric vehicle production. Economic situation and GM's decision. GM, one of the biggest automakers in the U.S., has decided to stop production at several plants, directly affecting thousands of workers. This decision is not a result of a recession or chip shortage, but rather a bold strategy to shift towards electric vehicle manufacturing. As a result, 1,200 workers in Canada and nearly 200 in Michigan have been laid off, with over 500 workers possibly not returning once production resumes. This shift is causing cities like Detroit and Windsor, Ontario, to face severe economic downturns. Workers who have lost their jobs are worried about their futures, not only because of the jobs lost, but also because of the difficulty in finding replacement employment, especially as the auto industry is rapidly transitioning to electric vehicles. Moreover, car prices are rising, making it harder for consumers to afford new cars. The combination of rising car prices and job losses will put a significant financial strain on families, especially those dependent on the automotive industry. GM's move towards electric vehicles may be necessary to keep up with the trend, but it also leaves a range of unresolved issues for workers and the local economy. Donald Trump's reaction and global impact. Donald Trump immediately condemned GM's decision, calling it betrayal and threatening to impose a 25% tariff on all imported vehicles not produced in the U.S. This tariff policy not only targets GM, but also creates significant disruption for the entire automotive industry. Global manufacturers from the UK, EU, Japan to South Korea will have to adjust their production strategies to cope with this tariff. For GM, this response goes beyond profit loss. The company projects it will face losses up to $5 billion, mainly due to restructuring costs and changes in the supply chain. As essential raw materials for electric vehicle production, such as lithium, cobalt, and nickel, are mostly unavailable in the U.S. and must be imported from Congo, Australia, and South America. This creates a major conflict between Trump's America First strategy and the globalization needs of electric vehicle production. The lack of these resources in the U.S. makes it difficult to implement tariff policies and forces automakers to reconsider their investment and production plans in the U.S. This not only impacts major companies like GM, but also adds pressure on the entire global automotive industry. Long-term results and personal difficulties. It's undeniable that GM and other automakers face significant challenges as they shift to electric vehicle production. However, maintaining tariff policies only makes the situation harder. Legislators are considering support for displaced workers. But tariff policies could permanently fragment the U.S. automotive industry. Families, workers, and small businesses are facing difficult decisions. Postponing retirement, withdrawing children's tuition, or dealing with supply chain disruptions. They are facing severe financial difficulties while the car market becomes increasingly inaccessible. Global car manufacturers are reevaluating their investments in the U.S., which could cause further damage to the U.S. automotive industry. The community is also struggling with unemployment, reduced income, and the decline of the local economy.
Boeing is losing billions of dollars due to Trump's 25% tariff policy. This has led to a $300 million USD loss from canceled orders. Production output has dropped by 20%, while Airbus takes advantage of the opportunity to gain market share. However, Trump still insists it's not my fault. Since the Trump administration imposed a 25% tariff on all imported airplane parts, Boeing has found itself in a financial crisis. Major airlines like Ryanair, one of Boeing's biggest customers, have had to cancel or delay orders for 100 aircraft. This alone has cost Boeing at least $300 million US. Other airlines, including Turkish Airlines, have also pulled orders, adding further pressure on Boeing's revenue. The impact of these tariffs isn't just about losing customers, it's also about increased competition. Rivals like Airbus have seized this opportunity, increasing their revenue by 15% in the first quarter of 2025, according to IATA. Trump's tariff policy has inadvertently boosted the competitive edge of Boeing's rivals, causing Boeing to lose critical contracts. One of the most severe consequences Boeing is facing is the disruption of its global supply chain. Suppliers from countries like Canada, Germany, and Japan have been forced to halt deliveries of critical components, such as landing gear, electronics, and other aviation parts. Parts Boeing cannot produce domestically. This not only complicates production, but also delays the fulfillment of contracts, particularly for models like the 737 MAX. In response to the shortage of parts, Boeing had to temporarily halt production of the 737 MAX, costing the company $100 million US in the next quarter. Boeing has been negotiating with suppliers from South Korea and Brazil to find replacements, but production levels have dropped by 20% in 2025, according to internal reports. This production halt has led to delivery delays, frustrating customers, and eroding trust. As Boeing struggles, Airbus and other competitors, particularly Comac from China, have seized the opportunity to gain market share. Airlines such as Emirates and Air India, which previously planned to purchase aircraft from Boeing, have begun to consider switching large contracts to Airbus. This shift has helped Airbus boost its revenue by 15% in the first quarter of 2025, while Boeing has lost these critical deals. This shift not only impacts current orders, but also has long-term effects on Boeing's growth and competitiveness. Airbus quickly captured the market for mid-range and wide-body aircraft, while Boeing's inability to maintain its production pace due to supply chain disruptions and tariffs has hindered its ability to keep up. Each canceled order cost Boeing anywhere from $3 million to $300 million US, depending on the type and size of the order. If the tariffs persist, Boeing could lose hundreds of millions of dollars. The company projects that 10% of its revenue, around $10 billion USD annually, could be lost if the situation continues. Not only does this financial strain affect Boeing, but it's also taking a toll on its workforce. In Texas, Boeing has laid off 500 workers, and the company forecasts it will need to cut another 1,000 jobs if the supply chain issues are not resolved. These layoffs primarily impact engineers and workers at component manufacturing plants, creating significant economic disruption in these regions. While Boeing has called on the U.S. government to intervene and lift the tariffs on civilian aviation, Trump remains firm in defending his tariff policy, arguing that it's necessary to protect domestic manufacturing and create jobs for Americans. However, in reality, Boeing is losing market share up to 25% this year to Airbus, putting the company's global standing in jeopardy. Experts predict that if tariffs continue, Boeing could lose an additional 5% market share by 2026, and the U.S. aviation industry could lose $1 billion over the next 2 years. While Trump's policies are aimed at protecting American manufacturing, they are actually reducing competition and pushing Boeing into an even more difficult position.
42% of Americans have lost confidence. The Dow Jones is facing its worst April since the Great Depression, and working families are beginning to ask, what has really happened to the world's leading economy? Markets collapse. Citizens lose everything by the end of April. All three major U.S. stock indices plunged. S&P 500 down 2.5%, NASDAQ dropped 2.5%, and Dow Jones fell 2.48%. The shock was so severe that the Wall Street Journal ran the headline, "Worst since the Great Depression." But this isn't just numbers. For millions of Americans, this is their retirement vanishing. Families depending on dividends, 401ks, or short-term investments suddenly had nothing to fall back on. Interest rates are surging. Prices are climbing. A simple lunch now costs more than a full day's minimum wage. Manual workers, delivery drivers, school teachers are watching their savings disappear before they can react. The big question is, who will rescue them from this freefall when economic stabilization policies are still under discussion? Policies miss the people. Trust in politics crumbles. According to a Rasmussen poll, a traditionally right-leaning source, Democrats lead Republicans by 4 percentage points. This isn't just a shift in polling. It signals a deep fracture in political trust. Why? Many voters say they feel recent policies serve only the elite class, failing to address real hardships like unstable employment, unfair taxation, and lack of transparency in public spending. One glaring example, a plan to cut $4.5 trillion in taxes for the ultra-wealthy, while simultaneously proposing to slash $880 billion from Medicaid, the health program for the poor and elderly. People are asking, when hospitals shut down, when medicine becomes unaffordable, do growth statistics mean anything anymore? Education, immigration, welfare, all under attack. Both Harvard and MIT face the threat of losing $3 billion in federal funding for not complying with policy directives. Letters from the administration demanded control over admissions, firing of faculty with opposing views, and elimination of diversity programs. Simultaneously, over 1 million immigrants were deported, many without proper legal process. Some were removed from the country without ever seeing a courtroom. The result? Millions of children left without parents, communities torn apart, and fear seeping into daily life. And it doesn't stop there. The Department of Education, though officially abolished, still operates to garnish wages from students who haven't paid off their loans. Recent graduates, barely making ends meet, are being financially strangled, while billionaires legally dodge taxes. Is it fair that a student is pursued for debt while the super rich enjoy loopholes? Data erased, trust broken, a cloudy future. When Harvard was sued, when science was censored, when weather, disease, and climate data were erased from federal systems. Americans began to ask, what is being hidden? A measles outbreak, widespread E. coli. Yet critical information is not reaching the public transparently. Meanwhile, the bond market is in turmoil, yields are spiking, and the probability of a U.S. recession in 2025 is forecast at 90%, according to Apollo Group analysis. Americans today are no longer just worried about gas prices or lunch costs. They're afraid that the entire foundation of their society is starting to crack.